Picture this. You've been doing everything right. Every month, without fail, you move money into your savings account. $200 here, $300 there. Maybe you've been doing it long enough that you've actually built up something real. A few $1,000s sitting there. And for a while, that feels amazing. But then one day you're scrolling through your phone and you see something that stops you cold. Someone your age is talking about their investment portfolio. Compound interest, index funds, passive income. And suddenly you're looking at your savings account, maybe $6,000, maybe $10,000, and thinking, wait, is this actually doing anything? You open the app, check the interest, and there it is, 0.4%, which means after a full year of your money sitting there doing nothing, you've earned something like $24. $24 for an entire year. And you start wondering, am I doing this wrong? If that sounds familiar, you're not alone. Because this is exactly where most responsible, disciplined people get stuck. They know saving's important, but they have no idea when to stop saving and start investing. Or how to do it without feeling like they're gambling with the money they worked hard to protect. My name is Jack, and I spend way too much time thinking about how to make money actually work. If you're someone who has savings sitting around but hasn't made the jump to investing yet, hit subscribe and give this video a thumbs up. Because today we're walking through the exact step-by-step path from saving to investing, without the overwhelm and without putting your financial security at risk. Okay, let's start with something uncomfortable. Saving money alone will not build wealth. Now, I know that sounds harsh, because saving is responsible. Saving is important. But here's the thing. Saving and investing have two completely different jobs. Saving protects your money. Investing grows your money. And if you only ever protect it, you're essentially letting it slowly lose value. Because of inflation, the quiet force that makes everything more expensive over time. Money sitting still is actually moving backwards. The average inflation rate in the US runs around 3% per year. If your savings account pays 0.5%, you're losing purchasing power every single year. Here's what most people don't realize. The gap between saving and investing isn't a small one. Let's look at the math. Say you have $10,000. In a savings account at 1% interest, after 20 years, you'd have roughly $12,200. Not bad. Now take that same $10,000 and invest it in a broad market index fund. Historically, the S&P 500 has returned around 10% annually on average over long periods. After 20 years at 10%, that $10,000 becomes around $67,000. Same money, same 20 years, but a $55,000 difference. That gap, right there, is why the transition from saving to investing matters so much. And yet most people never make it. So why don't they? It comes down to psychology, not math. Saving feels safe. You can see the number. It doesn't move. It doesn't drop 8% on a random Wednesday because some economic report scared Wall Street. Investing feels unpredictable, and our brains are wired to avoid unpredictability. But here's the problem. Playing it safe has a cost too, and that cost is invisible, which makes it feel like no cost at all. This is where it gets really interesting, because the path from saving to investing doesn't have to feel like jumping off a cliff. When done right, it's more like walking down a staircase, one step at a time, with a solid handrail the whole way. So, let's walk through it. Step 1. Build your real emergency fund first. Before a single dollar goes into investing, you need 3 to 6 months of living expenses saved in cash, not invested, not in the market, in a regular savings account where it's safe and accessible. This number isn't random. It's the amount that covers you if your life goes sideways. Job loss, medical bill, car breaks down, major home repair. Whatever it is, you need to be able to handle it without touching your investments. Here's why this matters more than most people think. The single biggest reason everyday investors lose money isn't because the market tanks. It's because they panic and sell at the worst possible time. And most of the time, they sell because they need the money. They didn't have a cushion. Your emergency fund is what keeps your investments safe from your own life. If you don't have this yet, build it first. Non-negotiable. Step 2. Separate your money mentally. This one sounds simple, but it changes everything. Think of your money as 2 separate buckets, not 2 accounts, 2 jobs. Bucket 1 is safety money. This is your emergency fund, your bills, your short-term expenses. Its job is to be there when you need it. It doesn't grow. It doesn't need to. Bucket 2 is growth money. This is money you won't need for at least 5 years. Its job is to grow. And because it has time on its side, it can afford to ride out the dips. Most people never make this separation. Their savings and their someday investment money all blur together in one mental pile. And when the market drops 10%, they panic because they can't tell which dollars are in danger. Once those buckets are clearly defined, the emotional noise drops dramatically. Step 3. Start smaller than you think you need to. Here's a mistake almost every beginner makes. They wait until they have enough to invest. $5,000, $10,000, some round number that feels significant. But here's what most people don't realize. The habit matters more than the amount, especially at the beginning. Most major brokerage platforms, Fidelity, Charles Schwab, Vanguard, let you start with as little as $50 or $100. Some let you buy fractional shares of funds for even less. The point isn't to get rich in month 1. The point is to start. Because the longer you wait, the more compounding time you lose. And compounding, once it really gets going, is almost impossible to replicate with late large deposits. A small investment started today is worth more than a large investment started 2 years from now. Step 4. Keep it simple. This is where a lot of people derail. They start reading about investing, get overwhelmed by all the options, and either freeze or start chasing exciting-sounding strategies. Crypto, options trading, hot stocks, whatever is dominating the financial headlines that week. Here's the thing. The simplest investments have historically outperformed the complicated ones. Index funds. That's it. An index fund tracks a broad slice of the market, like the S&P 500, which includes hundreds of major U.S. companies. Instead of betting on one company, you're betting on the overall economy. Diversified, low cost, and historically reliable over long periods. Warren Buffett, arguably the most successful investor in history, has repeatedly said that for most people, a low-cost index fund is the best investment available. That's not a beginner tip. That's what one of the greatest financial minds alive recommends for everyday investors. You don't need to be clever. You need to be consistent. Step 5. Automate and stay boring. Let's look at what consistency actually produces. Say you invest $300 per month into a broad market index fund. The market averages 8% per year. After 25 years, you'd have roughly $285,000. But here's the thing. You only put in $90,000 of your own money. The remaining $195,000 came from growth. That's not a trick. That's just time plus consistency. Now, you might be thinking, Jack, 25 years sounds like forever. But consider this. The hardest part of investing isn't picking the right fund. It's not timing the market. It's staying in when things get scary. Because markets drop. They always have. The S&P 500 has crashed dozens of times throughout history. And every single time, it has recovered and gone higher. Long-term investors don't avoid downturns. They survive them. And the ones who automate their investing, who set a monthly transfer and stop watching it obsessively, tend to do far better than the ones who try to manage it manually. Set the transfer. Forget about it. Let time do the heavy lifting. Let me give you a simple analogy. Saving money is like storing seeds in a jar. They're safe. They're protected. But nothing grows. Investing is like putting those seeds in soil. At first, it looks like nothing is happening. Then a little green appears. And eventually, you have something far bigger than what you started with. The seeds don't change. The environment does. Here's the truth most people eventually learn. Saving gives you stability. Investing gives you freedom. And the earlier you combine both, an emergency fund that protects you and investments that grow for you, the more powerful your financial future becomes. So, here's the path. One more time. Step 1. Build a 3 to 6 month emergency fund first. Step 2. Separate your safety money from your growth money mentally. Step 3. Start investing with small amounts and build the habit. Step 4. Keep it simple. Broad market index funds are where most people should start. Step 5. Automate your contributions and let compounding do the work over time. That's it. No secret strategy, no financial genius required. Just a clear path, followed consistently. If this video helped you see the difference between saving and investing more clearly, make sure to hit subscribe. And I'm curious about something. Are you currently in the saving stage, or have you already started investing? Let me know in the comments below. Because the moment you make that transition, that's when your money stops sitting still and starts actually working for you.